All right, everybody. Stocks by the numbers. Welcome back. Wanted to take a look here at VF Corporation, ticker symbol VFC, listed here on the New York Stock Exchange. Company closed $14.42, down 8 cents, about 0.5% here on the day. A little over 1.5 above that 52-week low that was recently hit early November, 1285. And the stock bounced up there back to that 20-plus level and has since been pulling back and selling off. Now, first of all, this is a retail company, right? They have all these brands here. As you see, you go to the site, you can see Vans, North Face, Timberland, Dickies, JanSport, Supreme, right? Honestly, I personally don't really stay too up with all this fashion and whatnot, but I know people do, and I know these brands are popular. This company's generating billions of dollars in revenue, but the stock has really been selling off and been in a downtrend for about the last 3 years now. So actually going on 4 maybe. But, I just wanted to pull up actually what brands they actually have underneath their umbrella. And some of these brands are very well known, and people, do look for these specific products sometimes. But I know North Face was in the news not too long ago, apparently throwing the race card out there. It sounded like, I don't know, you get a discount, like if you're black or something, or you pay more if you're white. I don't even know even exactly what the hell they did, but I know it was like if you acknowledge your whiteness or something, you get a discount. I don't know, but unfortunately, we know the saying, especially when it comes to the stocks. And unfortunately, the saying is, go woke, go broke. And everyone is really pissed off about this company as of late. But again, even more importantly, even before that, we can see that the stock has been struggling for years now, basically since 2020, right? So if we look before the pandemic, we can see this was a $100 stock. And then everything got locked down, right? The stock dropped about 50% down to 45 a share. It climbed almost back to where it was, to about 91. And then since that point right there, you can see it's about midway through 21. This stock has been getting absolutely decimated. Again, hitting lows of 1285, sitting down here in the low teens. So people are looking at this in two ways. On one end, obviously, you have the bearish side, which is saying, yeah, this company sucks. They're inconsistent. They're not efficient. They recently had that stuff with North Face now. That pissed people off. So there are people who make a pretty good case that this stock should stay down and isn't really worth your time. And then, of course, you got the bulls on the flip side saying, hey, listen, the stock's too low. They're doing some restructuring at the company. They're probably going to turn it around. Or they'll look at past performance, right? Oh, look, this was a $100 stock. You're getting it down here at 14. There's a no-brainer. People are talking about a potential squeeze back up to like 40. I saw price targets, realistic price targets, in my opinion. People were looking for like 17. Some people were looking for this retracement back here to this key level of about 20 and change. Okay, no problem. 40. I mean, listen, of course, anything can happen, right? But what I want to show you is, see, if you go back before 2020, if we look at the earnings here, look at this, right? Slight miss there on the revenue, slight miss again on the revenue, but we were up here in the high 3 billions. Missed 3 quarters in a row with the revenue, and then started hitting green, right? Got up to 3.5 billion. We're hitting green. We're hitting green. Look at this, just top and bottom line beats, right? What do I always say? Consistency. Look at that. Boom, beat, boom, beat. Then we start going into the tail end of 2019, and you can see a slight miss there, another slight miss on revenue, a miss on both the top and bottom lines, but granted, that was after the lockdowns. And then you can see we started to make a recovery, 2 good beats in a row, and then we miss on revenue. And then the next quarter, miss on EPS. And then we have a good beat, and then miss on top and bottom lines. Then we have a good beat, then we miss on top and bottom line. Then we miss on EPS. Then we miss on both. Then we beat. Then we beat. Miss on EPS. Miss on EPS. Big miss on both. So I'm sure it was tedious to hear me, go through that click by click. But what I was showing you is really, if you go back here, before this lockdown happened, there was much, much more consistency in the earnings, in my opinion. And the company has been struggling on the profitability side, as we saw, with a lot of EPS misses, but also the revenue has also been very inconsistent as well, in my opinion. So now, as we know, that's what happens with these stocks, right? When we're consistently beating estimates and we're reporting, a bigger forecast moving forward, we're going to be even more profitable. We're going to come in above those fiscal year revenue estimates that we originally laid out. This is all good news. And then you get price target increases, right? These analysts up their rating on the stock. Oh, they give it a buy rating. Now they give it an overweight rating. So the stock consistently reacts and consistently climbs off of consistent positivity. And now, unfortunately, when you bring in the negativity, this is what makes a stock like this fall all the way down from the sky. So not only is it I guess we could say mixed earnings, right? I mean, they've had some good quarters, they have some big misses, but as we saw, slight misses on EPS, but they were still beating on revenue. So it has been kind of 50-50 in my eyes here for the last couple of years. But more importantly as well, they also recently cut the dividend, as you see, up here 49 cents, right? We roll into 22, we're at 50 cents, 51, and then down to 30. And now we're down to 9. So the company is realizing that they need to keep more of their cash on hand and can't afford to pay it out for shareholders. And the problem is a lot of longer term investors, whether they're collecting those dividends or they're doing the DRIP, again, DRIP, dividend reinvestment program, whether they're dripping those dividends or collecting them, the problem is now, if you slash the dividends while at the same time your stock price is going down, yes, I see people make the argument, oh, they're paying a good dividend, it's yielding about 2.5%. Yeah, but also at the same time, as the stock price goes down, that dividend yield is going to go up because now it's a greater portion of current stock price that's being paid out. So again, the problem is I have no problem with people looking, in my opinion, for stocks that specifically have very, very high dividend yields, but also you have to make sure that the stock is not falling off a cliff as well. Because yes, your dividend yield may consistently climb up 6, 7, 8% in change, but if your principal investment just lost, 20% as the company is selling off and reporting mixed earnings, and, obviously at the end of the day, it's going to cost you money probably, in my opinion. But basically, this company, again, very, very inconsistent. But let's look at the numbers, because we have a $5.6 billion market cap, and the company's bringing in about half of that every quarter, right? We just saw earnings, and the company missed, but they brought in almost $3 billion for the quarter, and we have a $5 billion company. Right now, they're losing 2 cents a share, and we can see that on the EPS side, the company has missed 3 of the last 4 quarters. Now, next quarter coming up in May, EPS estimates are all the way back down to 3 cents a share. Revenue down here, $2.445 billion. That's due out roughly the middle of May. But if you look, not only has the profitability taken a hit, but also, it seems like the revenue recently has been stepping down, in my opinion. And even like this Q3 right here, you can see Q3 of 22, they brought in over $3.5 billion. Nice profit margin. Then you go a year later, and yes, I know they just missed earnings, but the revenue down significantly. See, that's why analysts were expecting the revenue to dip down. That's why, again, this time last year, speaking about last quarter earnings, that time last year, the company $353 billion, and you can see on estimates they were taking a hit, but they needed the company to not lose that much business, if you will, from year over year, and to go from $3.53 billion to sub $3 billion year over year, in my opinion, could be viewed as a very, very big red flag. And unfortunately, the net margin percentage has recently gone negative here for the last 4 quarters. And the debt also has been climbing as well. Let's look at some of the data here. As you see, 2 beats on the annual revenue side, 2 misses in the last 4 years. But you can see after this big jump in 2020, that's what I mean. I feel like a lot of these companies, the revenue has jumped in 21, 22, 23 after these lockdowns. But also at the same time, we know that costs to the consumer have gone up as well. So that's why I feel like this could potentially, I don't want to say be viewed as a red flag, but I don't know if a bump up in revenue like this could be viewed as a big positive. Because essentially what's going on is times are getting rough for the average person out there. So they're spending less, and we know that we have like record high credit card debt and whatnot. So in my opinion, people probably aren't splurging and buying this type of apparel unless they really have to. And what you're seeing here again, you're seeing the bump here from the 10s drops down to the 9 billions, and you see the jump up to 11.8, and then we're at 11.6, and now for 23 we're down at 10.5. So what I feel like my original point is, I feel like now they're taking, I don't want to say taking advantage, but I mean, I guess technically, they're kind of taking advantage of their consistent loyal customers because now there's less customers, but everything costs more. So you're generating more revenue, but it's coming from less people. So technically, you make the argument that it's potentially less popular. Because even if you look at the revenue coming in over the years here, you can see, I just feel like there's more competition out there. And also at the same time, a lot of Americans now, well, especially here in the States, but, I can speak to Americans, but a lot of people here now feel that it's purely value-based, right? If I'm going to buy like a JanSport backpack or whatever, and it's like, $50 or whatever, $60, if I can find another one for $30, I'm probably going to end up buying that one because times are extremely rough and I can't just, I can't just greed after brand names like I maybe used to several years ago. But you can look here, even in the outdoor segment, as you see, 2018, 465 billion down to 464. Throughout 2020, obviously it dipped down and recently came back. But we know there's a lot of other outdoor apparel companies out there that have been doing very well themselves, right? So if a company like VFC is losing market share to these other companies, then that's what I'm saying. Prices are going up, and yes, revenue may have jumped up as well, but if we're losing market share, then we're technically getting more revenue from less people, which in my mind, it can only really translate to a shrinking business. We can see here the work segment again was up to almost 2 billion, dropped down about half of that going into 2019, right? And it's been kind of climbing since then. You had a dip there from 21 to 22. But look, even like the jeans segment as well. I don't know exactly where this ties in now because as you see, they kind of repositioned all of these. So I don't know, maybe it's in the active segment here, but you can see, look at this, 2016, 274, and then down to 256, and then down to 249 billion. So the problem is, if a couple of their brands or a couple of their segments are struggling, then unfortunately it seems like, in my opinion, it's just going to lag the entire stock. And you can even see here in the States, this is what I was talking about. Look, 744 billion here in the States in 2016. 658 billion in 2017. Then they get up to 8 billion in 2018, drops down to 5.5 in 19, drops down to sub 5 billion for 20. And yes, it's gotten back up to above 6, but technically it dipped from 21 to 22, and these numbers aren't even back here where we were for 2017, and we're dealing with hyperinflation and higher prices, right? So that's what I'm saying. You're seeing a bump up in revenue, but is it really a direct indicator of the growth of the business? That's what I'm trying to look at here. And you can see even Europe. Look at these numbers that dipped down here even since 2020, right? You had the rebound back up to the 1.6 billion, but before that they were doing 2 billion and change, even over 3 billion here in 2018. So this is why I'm saying I feel like maybe anyone who wanted, an item of one of these brands either already has it or maybe can't afford it, or the third option is maybe there's just better quality or better prices from one of their competitors. Overseas, the Asia Pacific, look at this, we were up here 1.5 billion down to 136, and now we're sitting still at half of that really over these years, bringing in only about 700 million in change. So I know, again, a lot of those segments and areas, they do change, but yeah, I'm sure you can appreciate my point. On the revenue side, we can see going back about the last 8 quarters, we can see we actually have 5 beats and 3 misses. However, this last one does seem like a really, really big miss. Again, especially since we were above 3.5 billion, so estimates came down to 3.25, and then they don't even break above 3. So in my opinion, I think that's actually a bad sign. Next quarter coming up, estimates are down here on the revenue side, 2.45 billion. Q4 the year earlier, 274, they beat. Q4 the year earlier, 282, right? So we just went from 28 to 27 down to 245. And you can see that even the next quarter after that, revenue estimates are now sub 2 billion, going from 209, going from 2.25 billion, right? So we've seen estimates dip down, and I always think of Dell that we looked at recently, right? Because Dell, technically those numbers were slightly lower year over year, but the company has been able to come in above those expectations on the EPS and on the revenue side. So the stock has been reacting positively. And the problem here is, in my opinion, that I just think that this drop is too extreme. I mean, we're talking about like 20-30% drops in revenue here year over year. And then, like I said, now, as you're struggling, you're also now being divisive and putting out, racist promotions for one of your brand name brands, if you will, in North Face. Is probably one of the most recognized brands that they have under their umbrella, in my opinion. So, to me, it's just not adding up. I feel like they're literally like tripping over their own feet as they're trying to stand back up and get back into the race, But again, that's just my opinion, just the way I'm looking at it. But annually, we can see 2018, this company was rocking and rolling, hitting almost 14 billion. Again, that was prior to hyperinflation. Almost 14 billion in revenue. The next year down to 10. And then this is what I'm saying. We dropped down into 2020, but again, most of 2020 was a rough year for a lot of companies and didn't really do all of the business that they could have. So we can even say, all right, 10.5 billion, but they probably would have did about 10 billion maybe in 2020 if they didn't have that rough first quarter. But again, the rate at which we were printing these dollars and the rate at which the buying power of the dollar has been decreasing consistently over these years. The fact that this company, I feel, only saw a bump from this 10 to 11 billion, and now look, moving forward, 10.54, 10.58, back to 11, back up to 11.73. So by 2026, in my opinion, with prices going to continue to increase and climb, right, over all these years for the most part, we are now waiting till 2026 to potentially get back to the level we were in 2021, which more realistically is the level back here in like 2016 or 17 or something. That, in my opinion, that's the way I'm looking at it. I understand a lot of people may have just said, what the hell did that guy just say? Totally understandable, believe me. I know I'm a weird one. I think outside the box, but just look at how many years here this company was maintaining 12, 13, almost 14 billion in revenue. And now you're telling me 7 years later, we're at 11 billion. But costs are probably going to be up 30, 40% from where they were here. Like, you understand what I'm saying? So that's why I really don't know, unless this company is really able to turn it around and start annihilating these estimates and announcing buybacks and, increasing the profit margins and whatnot. Unless they're really able to completely turn it around and report nothing but positivity, I actually think that this stock may get worse before it gets better over the next couple of years here. Now, again, we do have the potential to break out of those wedges on these good reports, but I don't know. Looking at a lot of these results here, we have a 50-50 chance, right? If we look at a more consistent company that, for the most part, always beats usually on the EPS and the revenue side, then we could make the argument, there's probably like an 80-90% chance that they're going to beat earnings again and the stock's going to go higher again, right? It would make more sense. A situation like this, if you ask me straight up, what do you think? Are they going to beat earnings next quarter? I have no idea. I mean, it's literally 50-50. And even where they beat on the revenue side, they'll end up missing on the profitability side. So in my opinion, it never seems like a full, clear, positive picture. So that's why I'm saying, unless the company in the next quarter or two is really able to beat earnings and announce some big, big positive things moving forward, I actually think that they may keep the stock down. And I know a lot of people hearing this may get very upset because you guys might want, $17, $20 a share. Again, I mentioned some people are looking for a big explosion. If it gets above the moving average, they might take it up to $40 a share. Listen, if you own it, man, I would love to see that happen for you. I really would. I mean, that would be talking almost a 200% return from this level here, from 14 to 40. So again, if that happens and you've been holding for a while, man, I really do wish you the best of luck. But I'm just letting you know, in my opinion, what the company would actually have to report and tell us for you to see that move. And right now, it just seems very inconsistent. It seems very, very mixed. And we can see next quarter again, EPS estimates down here at 3 cents now. Year before, 17 cents a share, beating estimates. Year before that, 45 cents a share. So not only is the revenue stepping down and potentially stagnating for the next couple of years, but so is the EPS side as well. And you can see the following quarter here going into the Q1, again, that's sub $2 billion on revenue. Now the company losing 15 cents a share now on that Q1. And last time you can see they were supposedly estimating only a loss of 12 cents, and the company reports a loss of 15 cents. And then the year before that, they were EPS positive. And, I mean, technically they missed again, as you see, reported 9 on estimates of 13, but at least they were EPS positive, right? So, I don't know. It seems very, very mixed. And, again, 2020, 2021, you can see slight misses on the EPS side with a slight beat there for 22. And now look at profitability essentially halving from above 2 a share to 109 a share. And even moving forward, look, not even in 2026... with revenue getting back up to almost $12 billion, the company is forecasting EPS for the year of $1.97, which is not even at this 2022 level. And again, minus the big drop-off in estimates, which they had, again, for a lot of companies, because I know a lot of companies couldn't do business, and there was, like, the cargo problems and logistics issues. So I understand that all of these estimates for a lot of stocks went lower than what they previously were. But if you take out 2020, this company's up here, $2.68, almost $3 a share, $3.50 a share, even coming out of the pandemic, $3.18, still staying above 2, even though this technically is the lowest it's been. But now we're at 1, 1.3, 1.7, 1.9. That's what I mean. So even here on this number is technically less profitable than the company was 8, 9, 10 years before that. So I don't know. And in my opinion, this seems like a rough one again. The dividend took a little bit of a hit. Company again now only paying out 9 cents a share, was up to about 50 cents a share. Let's look at some of these fundamentals here. We have a negative EPS, so we have no PE. Trading about 0.5 times sales, which is the lowest it's been, but also at the same time, if sales are consistently decreasing, then our price to sales ratio should probably consistently decrease as well. Trading about 4.4 times cash flow, which is the lowest it's been if we go back the last 7 or 8 quarters. We're trading 2.67 times book, which is the lowest it's been going back the last several quarters. Enterprise value sitting here at about $12 billion. Again, market cap $5.6 billion. Enterprise value, again, is technically what another company would value this company at, supposedly. And as you see, it's about 100% higher than where we currently are. All of our return percentages are down. The gross margin percentage, though, has jumped up very nicely here, quarter over quarter, getting above 55%. That's actually the highest it's been going back the last 7 or 8 quarters. The operating margin technically did dip down here quarter over quarter, sitting at 9.4%. And before that, we were in the teens, but it really does bounce around for quarter over quarter for this stock. EBITDA technically down from above 14 down to 12. We had a couple of quarters before that in the single digits, but before that, we were maintaining some healthy double. So, yeah, I don't know if that necessarily would be, if some of these metrics would be viewed as a red flag. This gross margin going up is technically a green flag, of course, in my opinion. And the profitability we saw, yeah, taking a hit, dropped down. I mean, yeah, it was down here to almost 15%. And now we're sitting here at only minus 1.4%. So that's not too bad. Inventory turnover is down almost about 30%. going from above 3 here, dropping into the high 2.8s and even getting back above 3, and now just dropping into the low 2s. But technically, quarter over quarter, it is up. Asset turnover, again, the amount of revenue that the company is able to generate off of said assets on its balance sheet, as you see, is down maybe about 10-11% here, going from 0.89 consistently actually that's not true, going from 0.89 and was holding 8.485 for several quarters, and now as of last quarter 0.80. And the problem here with this company, as well as I mentioned earlier, is the debt. The debt has been climbing as the company has been struggling, and we can see now our debt ratios have been consistently increasing over time. And let's pull up the debt very quickly, and we can see again over the years here, company had a couple of billion in debt going into 2019. This is seeing the jump up in debt right there from 2018 to 2019, and these were actually their good years. So I feel like this company almost saw what was coming and took on more leverage to try to kind of weather the storm and keep the ship straight, if you will. But obviously, since 2020, the stock has taken a massive hit. But we can see now that as of 2022, debt has gotten above 8 billion. If we switch over quarterly too, we can see we climb up to 815, but then we slowly dip down 787, 78, 734 billion. So, that in my opinion is a good sign. The problem is this debt value here of 7.33 billion is about, 140% the value of the current market cap of the company. So we can't necessarily put it in the same boat as something like an AMC, but in my opinion, if the debt for the quarter is higher than the current market cap of the company, an analyst, in my opinion, would look at that potentially as one of the main driving reasons as to why they can continue to probably short the stock and even make, good profits off of the short. The cash flow, though, as we see here, the free cash flow in the middle, positive 41 million up to 135, staying above 100 million, drops negative 217. Now, as of last quarter, 1.1 billion positive free cash flow, and the company sitting here with almost $1 billion in cash right now, which for the most part, it has been bouncing around between 5 and 800 million, but now again for last quarter 989 million. So the company now has a couple of bucks here on hand. In my opinion, they probably could and should potentially keep bringing that debt down. Assets are outweighing liabilities both in the long and short term. Cost of goods, basically in line. Total revenue minus cost of goods sold yields gross profit. We can see the profit was up to almost 2 billion, dips down to about 1.5, last quarter 1.64. Gross profit minus operating expenses yields operating income, and we can see the operating income was hundreds of millions and actually dipped back down negative, and now for the last 2 quarters 350 plus million, last quarter 278 million. So that's why some of these numbers are moving up quarter over quarter. And again, if you simply look at how much business the company's doing and look at the current market cap, so it's undervalued, I can appreciate that. But again, I'm saying we're seeing even forecasted stagnation in revenue, right? I already laid out, in my opinion, how negative I feel about the EPS and revenue forecast moving forward and where the company was just several years back. So, unfortunately, I'm leaning more towards the bearish side here, but we have assets. Again, we were holding 14 billion. Now, as of last quarter, we're down to 12.6 billion. Liabilities were sub 10 billion and then immediately ran up to 11.33, since pulled back to about 10.5. But total assets minus total liabilities yields total equity, and you can see that the total equity in the stock has basically been consistently decreasing here quarter over quarter for the most part. Above 3.33 billion, down to 309, back up to 3.33. Now sub 3, down to 2.7, down to 2.2, now down to 2.1 billion. And I told you that as that goes down, the book value will begin to take a hit as well. And you can see the book value is down about 30%, I guess we could say, from 863, dropping all the way down here into the 7s, sub 7, sub 6, and now as of last quarter, sub 5.5, sitting here at 542. So if we're dealing with a struggling company that technically is trading, what did we say? Yeah, almost 3 times book value. I mean, this is why I'm saying we could potentially make the argument that we can continue to beat this company up. But I will say the positive cash flow, in my opinion, definitely a good sign for the company. But just looking at some of their segments, and again, the fact that the whole retail space in general has been getting beaten up, I just don't know if I personally see urgency to buy these lows until the company proves me wrong and shows me that they have found the bottom, they are turning it around, profitability is fine. They did some marketing campaign, hopefully not another, racist, divisive one, in my opinion, but, maybe they'll do another marketing campaign for one of their other brands, and that'll help, amp up some revenue coming in, and they'll be able to beat estimates and forecast higher estimates moving forward for the next couple of quarters, so the stock could start to gain some momentum. But here, in my opinion, again, looking at the chart, if we do potentially break out and have a nice rally, we could get up to that 20 mark, but we have been what's looking like in this big long-term descending wedge. This is going back to the lows there, end of March 2020, and I went here to these highs over here January 4th, 2022, because that was really right before it really started to chunk down and drop down really hard. So I went from those highs and connected down to this recent pop here after this previous earnings rally. But again, also at the same time, I know this stock was beat up, so a lot of people may have bought the dip. However, they technically missed again on the EPS side. And this is November going into December, which of course was a massive stock market rally, bouncing off of a lot of those long-term support levels. So the indices started raging, right? So we took this stock down from the 12s up to 20, even though they technically just missed on the EPS side, and now it completely gave it back for the most part. Now it's sitting back here at 14, and of course missed another quarter bigly since then. So this is why I say that big pumping markets, in my opinion, could be viewed as very, very dangerous, because you kind of get this false sense of security, this false sense of value, and then it starts to chunk back and give it away, and then you have the next earnings and it completely shits the bed, and boom, that's it. So it really does seem like a rough situation, but technically we are in this very long-term descending wedge, and like I said, we could potentially pop out here mid-May. It looks like apex is maybe 3 months after that, August, but actually even further than that, going into October, maybe that November quarter, where we could potentially hit the apex and pop out. But as you see, I'm down here now. So yeah, we're looking potentially $11 a share in change, in my opinion. That could maybe be like the low of the lows, but we do have... Yeah, we had the low, we had the high, so technically you can see, if you trace these trend lines, you could say we're in a descending wedge, and like I said, we could potentially pop out about a week before these earnings and rally up. But if the earnings disappoint, I mean, we could potentially bring it up here, like I said, to about 1560 and change, to this top trend line of this pattern here. And if the company beats, that's why I'm saying it could potentially try to get up and break through this support trend line that it recently broke. It could potentially break up and get to that, and then depending on what the company said, that's why I'm saying we could very well rally to this $20 mark. But unfortunately, it's really out of our control. And I feel like these technicals, again, it could be good for a little trade, but if we're talking about an actual investment, I have a feeling that we may have better situations elsewhere. Let's look at stock charts very quickly. I'll let you go. Looking here at the daily, we can see RSI down here at 35. Stock sitting here at the bottom Bollinger Band has been resisting for the last several weeks off of the mid Bollinger Band. Again, bad earnings report. MACD slipping down. We could, again, as I said, in my opinion, we could continue to sell off before we bounce and go higher. RSI on the weekly sitting here sub 40. Look at this sell-off. Bottom Bollinger Band 1387. So it's been above 14 all week, but we could potentially see that break from 14, and we could see the high 13s. Looks like the MACD has recently crossed to the downside also on the weekly, so that could add to the sell-off as well. We didn't technically hit that 30 benchmark before we had a little bit of a rally here, but then again, that's what I'm saying. We kind of immediately gave it back, and we're getting just these mixed piss-poor earnings reports. So I just have a feeling, in my opinion, the company is going to continue to struggle. But again, we do have those earnings coming up. On the longer term here on the weekly, you can see support level down here at 1080. Obviously, it seems like a big drop from here. However, remember, book value per share has been dropping. Now it's down to what, 540, which is almost exactly 2 times right there at that support level of 1080. So in my opinion, you could very well see 1080. You could very well see 1080. If they want to continue to beat it up and the company, in my opinion, reports another crappy quarter, you could very well see 1080. Switching over here on the daily, we can see we're actually right at a key support level here of 1454. And you can see we immediately broke, bounced up above it, broke back down, tried to reclaim and dropped down, tried to reclaim, and now we closed at 1442, technically below 1454. So we could make the argument that now we rejected, so we can continue to step down. Bottom support level here of 1283, which is right around the 52-week low of 1285. So we may not hit 1283 precisely, but we could potentially come down to 1285 and form that double bottom and then bounce. So only time will tell, but again, based off of last earnings and what the company is forecasting moving forward, I just don't know if I can buy into the hype of just looking at this situation saying, oh, they beat it up, so, now's the time to buy. Remember, like I said, you should always, in my opinion, find out the why something is happening. Oh, this stock was 100, now it's at 14 over the last 3 or 4 years. Okay, why? Try to find out the why. And even recently here, you can see S&P downgrades VF's credit rating after Q3 revenue shortfall here. S&P Global Ratings has downgraded the issuer credit rating of Vans and Timberland owner VF, citing a negative outlook and concerns with the company's third quarter results. Ratings agency lowered credit rating to BBB negative from BBB, saying the apparel and footwear company's third quarter earnings indicate that, quote, credit metrics will continue to deteriorate. So, in my opinion, that may translate to more leverage, taking on more debt. Earlier this month, VF posted third quarter loss and a 16% drop in revenue that missed projections. Said believes VF will have to sell sizable brands if it wants to meaningfully reduce leverage in the near term. Agency has adopted a negative outlook for the company, meaning it could cut the VF's ratings again if credit metrics don't improve in the next 12 to 24 months. So, unfortunately, yeah, it may get to a... And it's unfortunate, too, because, years ago, I know that North Face was a decent brand. I don't know how people feel about it lately, but that's what I'm saying. If for some reason the brand has gone out of focus of the public and has become less popular, then that's why I'm saying people will look at a situation like that and say, oh no, this other company makes a better product, I'm going to buy theirs. I'm not going to buy North Face. Or this other company makes a similar product, but North Face prices have gone through the roof, so I'm going to buy their product, and save myself a couple of bucks over there. So there could be multiple reasons as to why the consumer's dollar is shifting away from this company and their brands, but I don't know. It's just me, but I have a feeling, like we've been saying, go woke, go broke. I have a feeling making a marketing campaign about, I don't know, I guess admitting you're a racist. I don't even know what the angle is, It's like you're supposed to walk in and say that you're a racist so that you can save some money. I just don't understand where we've gone here. But, what is this? Engage capital input. It will appoint one new board member, select the second input. Another independent director. Not run for re-election. So, all right. So, potential board shakeup could be right, but again, I'm not bashing the company because this very well could be a positive, and these new people coming in could absolutely turn it around and bring the spotlight back onto the brands, and the revenue could come in, and they can stop doing, in my opinion, what seems to be really stupid in marketing and in campaigns. But I just feel like the change and the result may not be immediate. right? So it may take 6, 8, 12 months from now before, like I'm saying, the bottom is hit and then the rally comes and the positive catalysts start to outweigh the negatives, and then we're on the up and up and we're going back to 18, 19, 25. But again, this is my opinion. If you've been in this one for a while, if you want to address something that I am not bringing up, obviously that is what the comment section is for. I'm just going back, seeing CEO adds company shares, purchase of 65,000 shares. Well, I mean, that's a good sign, but we know also that a lot of these CEOs are literally just handed millions and tens of millions of dollars just for, showing up to work. So, I'm sure you've seen times in the past where you may have bought on that news of a CEO buying shares and then the stock continues to slip down. So, I don't want to go down the conspiracy road. However, we could potentially make the argument that maybe the CEO is buying shares just to kind of keep the stock level supported. But yeah, it seems like, this Engaged Capital board member coming in. So, we could potentially have a turnaround story. And unfortunately, it's really up to the company here. It's really up to the company. Again, we have earnings coming out middle of May. Again, forecast here, EPS and revenue estimates, both consistently dropping now year over year for the last 2-3 years in a row, whatever it is. And now the quarter after this, revenue dipping to sub $2 billion. So the company really has to turn it around and give us a reason for urgency. Because again, I looked at a couple of things and we could make the argument, we're going to drop to 1387 or whatever that mark was. The next support level 1080, right? We could potentially drop down and break down to there. If it does stay in this long-term wedge and then we pop out here towards the end of 24, as I mentioned, now we're down here at like 11 and a quarter, right? So we may still drop 25-30% from this level before we finally find that bottom and bounce back and make the U-turn recovery. So obviously, only time will tell. We can only control the controllables, but I wanted to look at a couple of technicals here that I was looking at, and of course we looked at a lot of fundamentals on the stock as well. So, let me know what you guys think about this one, but I have to say, in my opinion, as of right now, I would be in wait-and-see mode. I would let the company hang out, let them come out and beat these estimates and, forecast even better things moving forward, and let the stock rally and gain some momentum again, because as I'm seeing it, again, in my opinion, over time, we could potentially make the argument that we're going to hit new lows and consistently drop down without needing the urgency to climb up. That's the way I'm personally looking at it. And before people jump down my throat, let's actually go to this FinViz site, and I just want to check the short interest on this company. Before people jump down my throat, I just want to make sure. Why do I not see it? Okay, it's telling me about 8.7% of the float is shorted right now. In my opinion, that's not a big number. So I have to assume that a lot of people on, social media and in these forums, I have to assume that they're just looking at where the stock was, how much it got beaten up, and they're just kind of assuming that the worst is over, this is the bottom, and the recovery's coming. But in my opinion, I'm not really getting the same story from the company themselves. But that's just me personally. But, again, if you're looking for a potential short squeeze, or if you think the revenue is going to start chunking in, or also if you think that after getting that credit rating downgrade, do you think that VFC may actually end up selling off one or two of its brands to bring in a couple of $1 billion to kind of readjust the balance sheet and get all their ducks in a row? Let me know down in the comments what you guys think, but I'm going to end it there. So once again, Stocks by the Numbers, I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they are volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. It was nice of you to stop by. I hope everyone has a really good day.